Nobody then is predicting a rate increase. Nobody who's not on the Fed. And it would make sense if the Fed stays data dependent, considering the Fed's own outlook, why on earth would they raise rates this year?
So there are a couple of reasons. I mean, first of all, the Fed has moved goalposts so many times already, right? There was the unemployment number that was going to hit 6.5%. It's now even lower than that. So they've kind of removed the ability to be flexible here and keep moving the goalposts. A lot of the indicators that they're watching certainly are better at this point. Again, unemployment, yes, CPI is not where they'd like it to be, but it's really the trajectory.
What about
that
GDP
matters.
growth?
GDP growth is also coming off of kind of the weak number that we had earlier in the year.
A contraction.
Right, exactly. And also we are seeing the one data point that Yellen has been very focused on has been the wage growth number. And we're seeing pressures building there. And I think that makes her even less likely to keep pushing this out because at the end of the day, remember, the Fed is out of bullets at this point, and they don't want to find themselves in a market cycle that's turning because, remember, we're already in the 7th year of this expansion. They don't want to find themselves in the market cycle that's turning without any tools at their disposal.
Oksana, hang on just one second.
I could always just turn the printing press on full blast again, you know?
I just want to mention to viewers, we do have some breaking news. It appears that Restoration Hardware has been trading of Restoration Hardware has been halted at the open, pending news. The maker of my favorite towels, Restoration
Excellent.
Hardware. So we'll keep an eye on that. Oksana, what was your overall takeaway from everything we heard yesterday? The dot plot, the Q&A, the revisions downward of 2015 GDP. The market read it as dovish, right? Because Treasuries rallied, yields went lower, the dollar sold off. But when you look at the analyst notes, you saw Goldman Sachs push the likelihood of the rate hike out to December. Citigroup did the opposite. What's your takeaway?
So I think the Fed is going to stay on track and continue guiding as long as we don't see any meaningfully worse data coming out with respect to the U.S. economy. I think the Fed will continue to stay the course with being on track for a 25 basis point hike by September. But I'm going to try and offer a different point of view here because at the end of the day, irrespective of whether we think interest rates are poised to rise and, you know, we can debate the trajectory, the point is that fixed income today has never been less equipped to offer the three things why investors hold it, which is capital preservation, portfolio diversification versus riskier assets, and safe income.
Great
Fixed
point.
income has never been less equipped to deliver these things. And so the question really is, what do we do in portfolios to address this? The industry answer has been sort of this proliferation of unconstrained strategies. They are the new panacea, unconstrained bonds, and they're the answer to all of your troubles. But the reality is that what a lot of these strategies have done is that they've taken on a lot more equity correlated risk by trying to grab yield because that's what investors want.
They're taking on a lot more risk, bottom line.
Exactly.
Across the board.
Is that what you tell your clients to do, or do you, diversify with duration or get into corporate?
So the whole idea of diversification really needs to be re-examined because what we're dealing with today are portfolios where there's a lot more equity risk than ever. And again, a fixed income piece that's a lot less equipped to really deal with that. So if you look at, what happens when you buy a bond. When you buy a bond, you're taking on a number of risks, interest rate risk and a number of others, credit risk, default risk, et cetera. Interest rate risk is what's consistently gotten you out of trouble when your riskier assets were selling off. And that's a significantly less powerful force, irrespective of whether the Fed does move up the rate, the Fed funds rate, or if the rate environment continues to bob around here. And so the idea of diversifying by continuing to go long various sectors in fixed income globally simply does not work because you're just reinvesting in the same type of risk over and over and over again, which has a lot more correlation to the riskier part of your portfolio.
I love the point you're making, but so what do you do?
So the idea today is to step out of just that long-only mindset and think about, first of all, buying protection for your portfolio. So to the extent that you have credit risk, how are you going to mitigate the downside of it? So thinking about hedges, thinking about sourcing uncorrelated returns from the market, meaning stepping into alternative strategies, stepping into private markets, and to the extent that, this market is really constrained with respect to liquidity, and to the extent that you don't need it immediately, investing in less liquid parts of the market, if you can really, work with that type of investment horizon, that there is definitely a premium to be had there. We talked about Barney Frank earlier. He was obviously one of the architects of precisely the regulation that's put us in this significantly more constrained liquidity environment. I think that's a topic in and of itself that fixed income investors have to think about today because the market making ability on the street has plummeted. right? Dealer inventories are significantly low, at their lowest point ever. You have ETFs, for example, the top 5 corporate bond ETFs, their total assets under management are at almost double what the street is inventorying today.
Sure.
So what does that mean for this entire grab for yield that we've seen? And the other trend in the market that we've seen recently is a move towards the short end of the curve in an attempt to, feel that you're more protected from interest rate risk. But the reality is that when the Fed does go, it's going to be precisely that front end of the curve that's going to be the most exposed. So again, what does that mean when the selling begins?
And ultimately, the utility of buying treasuries just ain't.
We're getting a lot of amen sisters from the peanut gallery here. Oksana, thank you so much for joining us.